Okay, so we'll get started. My name is Bob Cohen. I am a SCORE mentor and joined tonight by Bob Fedor, who is also a SCORE mentor, has been with SCORE for many, many years, and Dan Toll. Dan's with SCORE both as a mentor and he also is a former banker and does work with the SBA. So he's the right guy for this presentation for tonight. And I think he's going to lead you through some interesting insights. First, what I'd like to do is just talk to you a little bit about SCORE for those who are new. And you know what? If you wouldn't mind, if you have attended the other simple steps parts of the series, so there's 5 simple steps series. If you were at any of the other modules, workshops in simple steps, 1 through 4 right now, let me know that in the chat. Just curious to know. This one that we're doing tonight is really based on finding funding for your business. And so it doesn't necessarily matter if you sat through the other 4 parts of this. I think you'll get something out of it. But SCORE's got the largest network of volunteer small business mentors in the nation. It's a national organization made up of about 240 chapters, just like the one here in the Cleveland area. In Cleveland, we have some 100 volunteers, and it is all based on volunteers. It's very easy to work with a mentor. So I would urge you as we go through this tonight, if there are any areas that you need help in, that we'd love to be working with you. One of our mentors can help you, and we can work from there. So our mission is to foster small, vibrant business communities through mentoring and education. So workshops like the one we're doing tonight and like this series for simple steps for starting your business, which again, this is number 5 of that one. And also one-on-one mentoring. Sometimes we'll have multiple mentors with one business, and sometimes even we will do boards of advisors for some of the small businesses that need our help, whereby we would bring in multiple people with various disciplines to help. So it might be a marketing person, finance person, production person, people that have those types of backgrounds to work with, your companies. So our volunteers, as I mentioned, we're all volunteers and we give freely of our time. We are free and unlimited, everything that we do. And we basically are looking at working with any types of small business entrepreneurs that are out there. I'm not going to go into the numbers, but one of our important aspects are our code of ethics. The advice that we give is totally neutral and based on your needs, because we don't and cannot make any money from your company. We cannot utilize your information. And we all sign off on a code of ethics every year that states that we won't do that. And we're very careful on how we monitor that. So you can know that you are pretty well protected. We are a service partner of the SBA. They provide a little bit of the funding that we need to run our organization, the rest of which we raise on our own and bring in enough money to keep us going. So basically, because we're an all volunteer organization, the costs aren't that very high to do that. So that means that when we contribute to the economy by creating jobs or creating businesses with you as entrepreneurs, it's inexpensive to do. So that's really something that we pride ourselves in. I'm just going to take you to our website for 2 minutes, and then we'll start the presentation. So what you're about to look at, there we go, is our homepage. So you can see that this is actually set up. All of these along the top are through our national SCORE organization, and everything in this blue band are things that are specific to the Cleveland chapter. As you can see, we also have in Spanish, and you can actually translate this website to some 70 languages or so that are, instant translation through Google. It's pretty cool. The other thing is, and the most important part of it is, how do you find a mentor? So if you go to score.org, and I'll put this in the, I'll put a copy of this in the chat in a minute. You go to score.org and request a local mentor, or you can browse mentors' profiles and you can ask for a mentor directly. But I'm just going to go to the request a local mentor. If you fill out this information, your name, your email address, and ways that we can contact you, and then in this paragraph down here in this box, give us a brief idea of what you need for your business or what you think you might need for your business. And we will try to assign you a mentor that fits the special areas that you might have that you need help with. So it might be marketing, it might be web development, it might be banking, it might be finance. So we've got, again, I mentioned over 100 mentors, and many of which are retired and have had pretty excellent careers. Some are still working. But bottom line is that we have all kinds of resources. I'm going to go back to this website for one more minute and show you some of the resources that are available. So in the resources that are out there, if you hit local resources, you can find things. We also have all of our workshops are online and available for you in a recorded session. We also have a YouTube page that you can have access to. If you just go to YouTube Score Mentors Cleveland, that'll bring up our YouTube page. Pardon me. And everything that's on that YouTube page will be available for you. So, I think that's probably about it. Just, a couple things. In 2022, we were Chapter of the Year. This year, we're District Chapter of the Year. So we're pretty proud of our record. So I'm now going to turn this over to Dan. Actually, Dan, let me just go through. No, I think we're there. I just wanted to show you kind of the roadmap. And this is where we're at. So we actually went through, pardon me, I've come back from traveling a little bit with a little bit of a cold. Startup basics, business concepts, marketing planning, financials, and now the last session, funding sources. Now I'm going to turn it over to Dan and let you start. Dan, why don't you tell us a little bit about who you are and what you're bringing to the table tonight?
Sure. Good evening, everybody. My name is Dan Toll again, and I've been in commercial lending since about 1993. I don't want to calculate how long that is at the moment, but it's a while. I've been involved in lending to the smallest of businesses and the largest of businesses, and a lot of them that are in between those ranges. I just wrapped up a 3 3/4 year tenure with the SBA last week, actually, as a contractor to the SBA. They're winding down the number of contractors that they need as they go back to non-remote work. So I am moving on from that, but I have that. I was very fortunate to gain that experience to understand how the SBA process works by reviewing applications that are submitted by borrowers and banks every day. So that's been very helpful and given me some additional insight that I didn't have into particularly how startups can get funded through through SBA backing of bank loans, and we're also going to talk about a lot of other, I won't say non-conventional, but a lot of other types of funding sources that are available, because not every business is going to be bankable right at the outset of its opening its business, and there are alternatives. The relative attractiveness of those alternatives depends upon your particular situation, but we are going to get into that and discuss those. Broadly speaking, I'm going to talk, when we talk about funding sources, it's a broader universe than just debt. It also includes equity, which generally refers to people that have an ownership stake in the company, the equity owners. We're also, in addition to the different debt sources that are out there, we'll talk a bit about the loan approval process and evaluation process for conventional bank loans, whether they are SBA backed or not. And I just conclude with a page of recommended steps for you to take to kind of further cement your conclusions as to whether you want to move forward if you're starting a new business or are perhaps want to step back for a while and evaluate a little bit more. Next slide, Bob. So equity sources consists of a variety of things. It's cash that you have on hand that you can contribute to the venture, whether that's in the form of savings, whether you get that by drawing on an existing or new home equity line of credit. Credit cards can also be used as a source of equity. 401k loans, if you have worked for an employer that offers that benefit, you can get a loan against the amount of your 401k. Cash value of life insurance. If you have a life insurance plan in which you're investing, there is a cash value that builds up as your contributions are, you pay your premiums and they are invested over time. There's a cash value that can be drawn against. And then also, of course, personal loans, which can also be used to contribute to your venture. Very popular way for businesses that are getting started is to look to friends and family members to contribute equity to help them out in getting started. That can be from debt or in the form of debt or in equity. And of course, the first sources that I talked about could also be in the, making your own loan to your own company is also possible as well, that you just then repay selectively over time. Network contacts as well, that people that know you and know your professional competence and are interested in co-investing with you. The first two categories are the very most traditional sources of drawing upon equity to get started. There is a sector of investors known as angel investors, and these are typically high net worth individuals that are still interested in investing in startup businesses. Their bent tends to be more towards what the last bullet point or the last note here tends to be more sort of in the same way that venture capital is oriented, more towards new products with a high tech or some high tech, new revelation to the marketplace with the potential to scale quickly, so that there is a opportunity for a substantial return on those investments. That's what the high net worth individuals that are so-called angel investors, they invest on their own behalf, sometimes collectively with others. If you were to Google Cleveland angel investors, there would be websites that come up that would grant you access, sometimes for a fee, to who these individuals are, because that's a way that they can access, on the other side, that they can access opportunities for investment, is by participating in these sort of marketplaces. But I notice Angie Harris has said here, applying for grants too. That is true, but grants are, they aren't unicorns, but they're semi-unicorns. They're around occasionally, but not often. And they're around often for nonprofit enterprises. But we're speaking tonight about for-profit enterprises, and there are occasionally grant programs that speak to, that are directed to more mission-oriented purposes, where they are uplifting disadvantaged, what are perceived to be disadvantaged portions of the population, or an industry that, for example, the federal government wants to see grow. There will be, there's all kinds of reasons that grants can be out there. There are less now than there have been in the last few years, in part because the massive monies that were allocated at the beginning of 2020 and again in 2021 as part of pandemic bill signed by Congress, which if you were familiar with the Paycheck Protection Program or PPP or EIDL loans, for example, those are forms of grants under certain circumstances if the money is spent in the appropriate way. And there are occasionally grants around, but I know that, for example, the 2021 bill, which trickles down, what happens is that federal money basically trickles down to states, and then from states to different counties and municipalities. But I know there was a recent burst of them because all of the money from that bill has to be allocated and spent by the end of July. So those are winding to a conclusion. And there are certainly periodic loans that are or that are sponsored by, or grants that are sponsored by pitch contests, for example, and other sort of special purpose events. But by and large, what you can literally and figuratively bank on is that you will be looking more towards bank loans on average than you would be to grants. I mean, grants are free money, and free money is scarce. And it's great if you can get it, and it's worthwhile searching for. So I'm glad that the point was raised. Absolutely, it's part of what we look at for our clients. Again, very applicable to nonprofit, less applicable to for-profit businesses. Mentioned venture capital. It's the same deal where, if you think about the big ventures of Google, Amazon, these companies were at some stage funded by venture capitalists that invest very early on, again, in anticipation of significant growth and ultimately an exit that gives them a substantial return in the form of a company going public or being bought by another company. But less available to, and another part of what we're really oriented towards here is Main Street businesses, where people are starting, plumbing contractors that are starting companies, or someone starting a restaurant, different, again, or a retail store, or some type of manufacturing business or service business. Seeing a lot of people start wellness businesses online, for example. Those types of businesses that are sort of within the kind of the pure purview of what's sort of already known in the universe, as opposed to somebody trying to create the next big widget or idea to market, which is basically financed by the angel investors and venture capitalists. So why do I bring them up? I just wanted to bring it up because it's part of the spectrum that is out there. Crowdfunding is another type of funding that's available for both debt and equity. Crowdfunding is essentially a marketplace where there are people that, like you and me. It's basically, crowdfunding was designed to make investments more accessible to people like you and me, as opposed to just the 1%ers or the 1 to 5%ers that are in that angel crowd or venture capital crowd. With crowdfunding, I can sign up, and I have signed up on different crowdfunding sites, mostly to see the offerings as opposed to invest in them to this point. But it basically allows one to invest in increments as low as $1,000 or less in the equity, have an ownership stake in a business, or lend money to a business. A lot of crowdfunding sites, like grants, have more of a mission-oriented tint to them. So, for example, I saw one today on WeFunder that is where people producing a documentary on some sort of social issue that I can't recall at the moment, but we're soliciting funding to help produce that and get it to the marketplace. And so the reward there is, yes, you have ownership in it, and yes, you'll get some kind of return for whatever is the broadcasting rights or whatever avenue through which that's going to be broadcast. But there'll be some returns. But again, it's a lot of time. Not to use it flippantly, but sort of more touchy-feely. where people that want to see certain causes advanced will invest in a business. It also is also just hard, hard money where people are looking at it like, no, this guy's starting what have I seen? I've seen a restaurant or a brewery, for example. I want to be a part of that brewery because I think it's going to be successful. I can invest my $1,000 and get an equity return via dividends or a sale of the business at some point down the line. We can go ahead to the debt sources, Bob. Some repetitiveness here. Friends and family, network contacts, again, very familiar. They are very familiar in the sense that they are often utilized. It's important if you're going to friends and family or your network contacts for money that you sign a promissory note and any other documents that are necessary to spell out the terms of repayment. Because the last thing that you want to have happen, and I've seen it happen, is where when things don't, if everything goes right, everything's great. If the business doesn't turn out the way that everyone expected at the outset, if everyone doesn't have a clear understanding of how things are going to proceed, there can be disagreements, there can be bad feelings, and that can have repercussions beyond just the business that's being funded for friends and family. So it's something you want to proceed with carefully, and by documenting it, not only is it legally appropriate, but it also conveys a conviction that you are going to repay that money, and that even though it comes from dad or uncle or your best friend of 20 years, you still intend to make good on it. Again, business or personal credit cards, they can also be used to draw upon. A lot of people get started doing this before they get to a funding stage. Those first steps are often funded by credit cards, very common, which then gets taken out, repaid once you get a bank loan or some other mechanism of funding. What we think about most commonly are the national banks like Wells Fargo. I mean, for all intents and purposes, KeyBank, Huntington, locally, the Bank of America, JP Chase, et cetera, the national banks, and then community banks, First Federal, Lakewood. There's a number of them. I couldn't hope to enumerate all of them. Credit unions are also a very good target for small businesses. There's a number in the Northeast Ohio region that support startups, usually with SBA backing, but it's not an institution to be ignored. And then SBA guarantee programs, the key that unlocks the door to SBA-backed lending, which is, and just to describe it, basically, it's where the SBA is not a direct lender. What it does is step in and support a portion of a loan made by a bank. And that percentage can range anywhere, depending on the type of program, from 50 to 90%. It's usually in the range of 50 to 75. But what that does is it enables the loan to occur, because absent that guarantee, a bank, which would face the full 100% of exposure if the loan was to go bad and was not repaid, would have significantly less exposure than it would otherwise have. So that is reflective of this key that I'm talking about, and that's what's called the no credit elsewhere test, or NCE, which basically means that because of the circumstances of the business, whatever it could be, it's that it's a startup with no established track record. It could be that it's a special purpose type of business, or has a special purpose type of collateral. For example, bowling alleys. It's very hard for a lender to take back a bowling alley if the loan goes bad and be able to resell that or get it back out to someone for anything else than a bowling alley. Whereas, for example, if you have an industrial warehouse as collateral, that can be marketed or sold to any number of businesses in the market for an industrial warehouse. So that's what special purpose conveys. And there are in the banking community, there's also types of businesses that are deemed areas of caution. Hotels and motels would fit that example. And it's largely due to loss history. Restaurants also fit that category, simply because they can tend to have a greater rate of failure, or in terms of the loan being repaid, than other businesses on average. But so it's getting that no credit elsewhere test, which means that there's no credit on generally, marketable terms in your given market. You can't get conventional credit terms because basically meaning a lender won't lend to you is what it means, without that kind of support from the SBA. And that's where the SBA comes in, because the SBA, at the end of the day, is an economic development instrument of the federal government. And it wants to be in place. It's there to be in place to make capital accessible to more risky types of enterprises. That's its goal. Because otherwise, there'd be a lot of worthwhile businesses that would not get funding on more conventional terms, simply because the industry in which they are in, on average, has a higher loss rate for banks. There are different kinds of SBA guarantee programs. The 7A program, I mentioned working capital here, but it has a wide number of uses. Working capital can be used to acquire equipment, can be used to acquire real estate, leasehold improvements, really refinancing, number of purposes. And maximum loan amount is $5 million. And there are a subset of under the SBA Express program where the maximum amount is $150,000. And that receives, I believe, a 50% guarantee from the SBA under those programs, but that's because it's a lower dollar amount. So in essence, when a $150,000 loan and at max is 50% guaranteed, $75,000 loss as opposed to a $3.5 million loss or $2.5 million loss for a bank is much different for the bank's risk profile, especially if it's a national bank, a very large bank. So that 50% lesser guarantee is enough for those lower dollar loans. The Community Advantage program has been at this point sourced out to mission-oriented lenders. It's still in existence. It was a test program basically for the SBA, and the Community Advantage loans are administered by mission-oriented lenders that are not for profit in the way that banks are. For example, ECDI, which is actually based in Columbus but has a Cleveland outpost, that's a mission-oriented lender. And ECDI, if you look them up, you'll see that they provide a number of other services to entrepreneurs and disadvantaged populations as well as other folks, as far as training and in any number of areas, and they're more accessible. And they have taken hold to provide more accessible capital. They've taken hold of the SBA basically kind of disgorged themselves of that process, even though they still back them, and they're being administered by these sort of community-oriented organizations. Next slide, Bob. There are also microloans. Again, that's administered by ECDI. There are other, and I talked about these mission-oriented lenders. There are other local economic and community development. One that I note here, simply because they are a kind of a lender of last resort, is HFLA of NEO. It's based in Beechwood on the east side, eastern suburb. And if you've been denied for financing, they will, and can demonstrate that, they will give you a 0% interest rate loan up to $10,000. There was talk that they were increasing to $25,000, $25,000. They still don't reflect that on their website, but they may have increased in amount. But for the record, they're still stating $10,000. But again, $10,000 is a lot of money. compared to zero. So if you're not getting funding and you want to try another lender, it's a good place to try. Broadly speaking, there are other lenders in the marketplace that are not bank or these community-oriented lenders. For example, there are online lenders that, and I give the names of some of the examples here, that where you can go and enter more basic information like, what your personal credit score is. That's going to be important to any loan that is granted to you as on a startup basis. Your personal credit score, dollar amount, what's the loan going to be used for? What is the business? There are a series of questions that these sites will ask you, and then they will come back with an offer or offers, different kinds of loan structures, or not. I mean, it's up to with the online lenders, it's up to their particular risk tolerances as to whether they want to provide a loan to a given startup, and it depends on their specifics. There are also lender marketplaces like Lendio, which has a network of 65 lenders that look at submissions, applications for loans submitted in their marketplace. So Lendio is basically it's a channel through which you can indicate what you want as far as a loan amount, same kind of basic specifics that the online lenders require as far as the application process goes. And in this case, then it's any one of these or more of these 65 lenders coming back to you with offers to lend. Important thing to note about these folks, it's more expensive. It's the same thing as with credit cards. These loans are more expensive, and the reason why they are more expensive from an interest rate standpoint, and also more strict from, say, a repayment standpoint. They might require weekly repayments or daily pull downs of available cash to start repaying the loan. It just depends on the circumstances, but they're higher rate, and the reason why they're higher rate, they can be as high as credit cards, which can be 25%, 30% and above. The reason that they're higher rate is because they get less information about the borrower. They're requiring less information, so they charge more because from a risk profile standpoint, they are more likely to take losses. They're not looking at your business plan. They're not reviewing it in detail. They're not meeting you. It's not to diminish these lenders at all, because the attractiveness of any one of these types of lenders really depends upon your circumstances, your resource constraints, and your risk tolerance when you start your business. It could be well worth your time to take a loan from an online lender or a business credit card that may have a 30% effective annual percentage rate. If 2 weeks or a month of that can get you a customer or two and get you started, that may be well worth it to you if you don't have access to the other conventional forms of lending. And so it really just depends. And that's why it's important to mention them, because you don't want to think that it's all, banks are nothing. That's not the case. And I know people that have done this. They've worked the credit cards, and then once they do that, it takes a heck of a lot out. They may not even make, money at all for the first 2, 3, 6 months. But after 6 months, say, for example, when they're starting to turn a profit, they got a track record. So you start migrating from unbankable to bankable, because what a bank typically looks for, absent an SBA guarantee, is a track record that they can lend against, because ideally they're not absorbing the whole risk of the business failing or not. They've got a cash flow that they're underwriting to. So it can be very useful, albeit painful on a relative basis, to absorb those kinds of rates, but it's something to consider depending on your circumstances. There are other types. We've mentioned crowdfunding, and it's the same type of deal where they will typically, it depends on, I know Honeycomb, for example, they will look to have some input on the terms of the debt that you put out there. because they do this all the time, and depending on what your circumstances are, they will have more insight into kind of what clears the market, if you will. The other aspects of crowdfunding that I can mention now is I didn't mention earlier, it is regulated now. 15 years, maybe 20 years ago, even now, I don't know. Time has passed so quickly. It was the Wild West, where it was unregulated, and basically was people going to the, people getting in essentially an online marketplace and looking at business plans and whatnot that are submitted by businesses and saying, okay, I'll take a piece of that. But it wasn't regulated. And so that being regulated, as often as regulations are decried by small businesses, and in a lot of ways appropriately so, from an investment standpoint, regulation protects both the issuer, the borrower, and the investor. So what does that mean? It means that they're required to put forth the same documents that a company going public would have to put forward. Basically, it's it's smaller and it's not as much information, but it's like a registration document that's filed with the SEC for a company going public. There are certain requirements that have to be met. It's basically an offering memorandum. It'll have aspects of your business plan, and it'll have a lot of legalese in there that essentially provide protections to both the investor and the borrower. The fifth bullet point here, there are different types of ways. Again, there are many ways to approach your funding needs at the outset. Leasing is popular, and the other good thing about leasing is that there are now so-called micro leasing, which means smaller dollar amounts that are available for all types of equipment. Computer equipment, which granted has a relatively short life from an IRS standpoint, and just as everyone knows, perhaps from using their own computers, you're typically going to have a shorter shelf life compared to either the next great thing that comes around the corner, or just in terms of how well it functions. So it's got a shorter life cycle. Or if you need equipment for your business, if you're manufacturing, or if you need equipment / furniture for your restaurant, anything like, you can look to equipment leasing. Now, I'm not saying it's easy to get, because again, they are looking at a startup, but the important thing about it is that it's no cash down up front. And so it's like you put down for a conventional lease for renting an apartment or a home or what have you, you're going to put down a security deposit, but in essence, you're not buying it. So you're not having to come up with all that liquidity up front. And it's just usually a monthly roll from there. So again, it's a way of minimizing the amount of cash that you have to put in up front to get your business going. Invoice financing and factoring are basically two ways of invoice financing. Is basically if you get an invoice from a customer, or you issue an invoice, excuse me, you get a customer, you issue an invoice, and you're a manufacturer, for example, and they want 100 units of your product, and you issue that invoice to them. Well, you probably you're starting up. You need to build inventory to make that, to make all of that product, and then carry it until you get paid back. What happens is, a third party, you basically sell that invoice at a discount to someone that takes on the invoice, and in your stead takes on the risk of that, and basically allows you to get the cash to do what you need to fulfill the order. Similarly, factoring is more applicable to accounts receivable than it would be to inventory or other assets. But for example, I sell, oftentimes in the business world, buyers will get terms, meaning that, and a lot of times you have no choice as to where you offer terms. So in terms of repayment. So whereas with a restaurant, for example, you got the credit card, the merchant credit card payment thing set up, you get paid right away, less your discount fee. So that's the nice part. of having that kind of business where, boom, you sell it and you get the cash right then. There's no carry on that. But for a lot of business to business sales, it is standard to offer, depends on the industry, but it's standard offer terms, meaning that you will give your customer 30 days to pay the bill that they owe to you without tacking on any interest or points or other fees. That's a very common length of period. The problem for you is, as a startup, is that you need the money coming in. So similarly, factoring says, a factor comes in and says, well, I'll buy that off of you at a discount, say 80%. It's going to depend upon, it mostly depends upon what the factor is looking at is the credit strength of the company buying your product, that has bought your product and you're waiting to get sold. So for example, if you're selling something to, if you're lucky to be selling something to Pepsi Cola, you're going to get 90% of that because Pepsi Cola is, as good a risk as it gets. So what it does is essentially bridges that funding gap, which is a classic so-called working capital gap. This is a classic working capital need, and it's related to the timing of cash outflows versus cash inflows. So I've got to make this thing. So I've put in my money to make my 100 units of product. So I'm out there and, I don't have, and I'm going to have, maybe I have limited resources. Let's just assume for the most part that most businesses have limited resources, else otherwise they wouldn't need debt or additional equity. So it's important to be able to bridge that gap, and factoring comes in and says, okay, I'll give it 75%, 10 days. So that's great because it gives me grist for the mill. I can keep going. I can either repay my credit card, repay my loan, whatever it is, I can repay. So I'm reducing the interest charges that I have, or I can start investing in building product for my next customer. And that's essentially, I also want to mention at this point, just real quick, because working capital is a very broad term, but essentially what it means is it's funding those kinds of timing gaps. That's the most classic type of working capital need, where I have certain fixed expenses every month, but I've got a bunch of customers that haven't paid me yet. So I've got to carry that cost. That's what a line of credit does. You draw down a line of credit to build your inventory, buy, and whatever you need to do to finish the product. And those costs, you support it with a line of credit. And then as you get repaid, you pay it back down. So a working capital line just typically will fluctuate in the life cycle in the life cycle of the sale of the product, from building to selling to cash conversion. So when you hear about lines of credit, no, I need a line of credit, or this is going to be for working capital. In working capital can mean different things, but most conventionally and most prominently, it refers to those kinds of timing gaps. Next slide, please. Loan approval process. If you participated in any of the prior simple steps presentations, there's a lot of discussion from session 2 on, which is basically identifying your business idea and evaluating it, assessing the feasibility of it. Well, in essence, what you're going to provide to get your loan approved, and now we're looking at sort of the classic situation of a bank loan, SBA supported or not. That first thing is going to be your business plan. And the business plan is essentially what that represents is a yes answer to your feasibility analysis. You've determined that based on your research, this is a viable opportunity that you're going to invest in and run, okay? And your business plan is basically an expression of the information that persuaded you that it's going to find, that your business is going to find a place in the market. And so you've got your business plan, and they'll ask for a personal financial statement, because again, you have to remember, when a business starts, the difference between you as an individual and the owner, operator, and the financial profile of you and the financial profile of your business is, there is no difference. It's the same. So They're going to look at your personal financial profile. They'll look at your tax returns, your projections, and it's always good to provide a sources and uses of funds, which basically says, okay, I'm asking for 100. I'm going to use 50 for equipment. I'm going to use 30 for inventory, maybe 5 for marketing, and maybe 15 for initial working capital. Okay, but that helps the lender understand exactly what you're going to use the money for. You want to identify lenders and try to set up meetings. It's harder to do that these days than it used to be, which is kind of unfortunate for both sides of the equation. I mean, I was a credit officer for a long time, and I didn't do credit from an office. You need to be out meeting people, the same as your account officers are. You need to meet them, understand them, because there's a lot to be learned, both from observing them and listening to how they describe their business and what their background is. There's a lot of important information to be gathered person to person. Generally speaking, the smaller lenders are going to be more apt to be able to provide that to you than the large lenders. If you want to submit an application, Huntington Bank, based in Columbus, but obviously big here too in the Northeast Ohio. Huntington Bank is one of the 10 largest SBA lenders in the country. But if you want to submit an application to Huntington, what will largely happen is you'll go into a retail branch and the branch manager will give you an application, give you a little talk about what the process is, give you the forms, and then you come back with it. It's not the same as actually talking to the people who are going to handle your loan, which you can get at a smaller bank or a credit union. There's pros and cons, right? I mean, the large banks are going to have the appetite. They're going to do more because they've got the much larger capital base. They can absorb more losses. And they've got Community Reinvestment Act requirements, regulatory matters that have to be settled from a regulatory perspective. The OCC and the FDIC, they have to be responsible in terms of making sure that they're just not giving money to the richest people out there or the best businesses out there. They have to be making tangible investments in their community. And one way to do that is to make SBA-backed loans. So, Huntington can be very good. And it's not a knock on Huntington. It's just where we are today in terms of branches, how banks use branches. If you do want to go there, I would suggest going downtown. Go to the headquarters, go to their largest office where you have an opportunity to hopefully meet someone. We can also help you with that. There's a lot of us at SCORE that have worked with lenders before. I certainly know a lot of lenders where we can provide you with, we're required to provide you with at least three potential sources. So, I could give you a credit union, Huntington, and First Federal, for example. And at least you could say, hey, well, yeah, it's, I was referred by Dan at SCORE. Even that little bit, number one, it says you talk to SCORE. You talk to somebody that's probably helped you, that has had a third-party kind of perspective on what you're doing. In other words, there's already been a first look at this. And that's not a pitch to say, oh, gee, I'll come to SCORE. But it does help. I mean, when you get a referral in, it's typically a SCORE lender is not going to refer something that, they don't believe has a good chance of working. So, if you get one of these meetings, practice your presentation and ask questions when you're there. Ask them about the approval process, how they're organized, what the timeline's going to be for a response. And importantly, don't sugarcoat the risks. In fact, as part of your feasibility analysis, you have hopefully encountered the risks of what you're doing in terms of who the competitors are. I mean, most prominently, what the competing products are, what the competing businesses are, and assessed how you can wedge in a spot, how you're better, how you're differentiated. And but there are risks, and there are always risks, particularly with startups. I mean, the best intention, the most well-researched, sometimes it just doesn't happen. And that can be for circumstances that are completely unrelated to the market. It can be macroeconomic circumstances, for example, that have an impact on your potential customer base. There's any number of things that can happen. So it's important. It shows that you really understand your business or the business you're thinking about going into, if you can identify the risks as well. Because the last place you want to be is, and there's discussion of this in prior simple steps presentations, but the last place you want to be is, I mean, passion is good. Passion is outstanding. In the words of logic, it's required. But passion alone is not sufficient. You have to do the research. You have to know that day one, when I draw down on that new loan, I'm on the clock. I got somebody to pay in 30 days, or sometimes a lesser interval. And I got to know where my customers are coming from. I mean, tangibly, I got to know. Because I have to have a high percentage of close on X number to be able to pay my loan back in the first month. So you need to understand what the risks are going to be. So you tailor your marketing pitch, your everything about your business to make sure that you are optimizing your chances for success. And so it's really, it's the passion, definitely, but also the research, the knowledge that is what gets these things done in terms of third-party investment in your business. It's okay to say, I don't know. Don't pretend that have all the answers, because no one has all the answers, including the lenders on the other side of the table. No one knows everything. So if you don't know, say, no, I hadn't thought about that, Chuck. I will, can I get back to you in 48 hours or so? Let me do a little more research into that, or put some more thought into that. Next page. Approval process, very quickly. There'll be 2 or more people on the deal looking at your loan, I should say. Typically a relationship manager or account officer, and maybe a credit analyst. They will essentially, in the end, put together their form of a business plan, a credit memo, which essentially takes a lot of the information that you've provided and is formulated in a way that a lender makes its determination as to the strengths and weaknesses of the proposed lending opportunity. So they'll review that information, so-called spread your financials, which puts them in a standard format to see what your profit margins are going to be, how leveraged your company will be, different things that lenders are interested in seeing. And then the credit memo, which essentially analyzes to the best of their ability, the lender's ability, what your business represents, its chances for success, and whether they, as the relationship team, should recommend it for approval. Next page. Approval process. So there's 2 types of authority in lending institutions. Classic authority. There's signature authority, which is basically where one individual signs off has the authority to sign off your loan. Or there's a loan committee process, which is where there is a standing committee of individuals within the bank who have, on those, or the members of those committees can vary by the size of the bank, and by how large the various interested parties within the bank that are going to be involved and have a stake in whether deals get approved or not, from whether it's a risk management standpoint or a sales standpoint, like the relationship manager, account officer. And the signature loan authority, the nice thing about that, in short, is that, and that's what I had, signature loan authority, that means to up to a certain dollar amount, I can approve your loan or not. And so RMs would come to me and say, present the same kind of information, credit memo, et cetera. I would evaluate it, talk with them, see if I have any questions, blah, 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 and then, sign off on it or not. And then there would be somebody above me. If your loan was above, X number, there'd be somebody above me who has the signature authority to do that amount of loan. And that's how signature authority works. The downside is, if the signature you need, that person is out of town, literally. There will be somebody who is a backup, but backups are a little less within banks willing to stick their neck out, because they're not going to own that loan going forward. So they're a little more cautious, a little more conservative, typically, on average. That's the downside. Nice part of the committee process is, boom, that thing's meeting Tuesday and Friday of every week. And sometimes it takes a couple of committees. You might go through a preliminary committee and then go to a secondary committee, which has the ultimate authority to approve the loan. And that's the benefit of a committee, is that from a timing perspective, they should be able to deliver a fairly specific timeline as to when you will find out whether you get a loan. The downside into the committee process is frankly more people looking at it, because you've got the relationship manager, you've got a credit analyst that working with him or her. Maybe you've got a credit officer that's on board, but then there's other people who, and I worked for a large bank in Chicago where the chief credit officer of the bank sat on that committee, and there would be other people on the committee that weren't even in the same business line. So you've got other people with other perspectives that may not be aligned with, say, sort of exactly what the commercial lending unit wants to get done. That's a risk. Is it just simply more people? That means potentially more questions, more perspectives that have to be addressed. And unfortunately, maybe more places where you might get a no. And in a committee process, it can be a majority. It might require 100% approval. It just depends on the institution. Anyway, after you've gone through that process, the outcome is communicated to you. You get a term sheet, and you can move on from there in terms of negotiation. The most important point is that there is some amount of fear that exists with a lot of people. Oh boy, I haven't dealt with banks before, which I completely get. And I view a big part of my role in this process right here is saying there's nothing to fear in terms of the process. There's zero mystery. What I have described, or maybe one fraction of a derivation thereof, is going to be exactly some form or another. There's going to be exactly what I've described here that's involved in the process of approving or denying your loan. And it's important. I'll just say one more thing. If you are denied, ask why, because it may be indicative of just that institution's perspective, or it may give some clues to where maybe your business is a little weaker, or some risks that perhaps you haven't thought of. It's useful information, albeit painful and disappointing. It's useful information to have. How is the loan evaluated? There's a standard rubric that's been in existence since the 50s, 1950s, that is. The 5 C's of credit: character, capital, capacity, collateral, conditions. Next page. Character, it can be, each of these terms can mean different things, but I've generally covered what they mean. So it can be, character can refer to how you've handled your obligations previously. Can also refer to what your industry and market experience is, which is a big factor. Okay. Professional experience kind of woven into that. It is much harder to get a loan, certainly from a bank with SBA backing, if you are starting with no experience in an industry versus having some experience in it previously. So for example, I've seen people who have started restaurants where they've literally tended bar in that restaurant. Why? Because it gives them an insight into everything that's going on in the business. And it may not be their direct responsibility, but over time, you understand how that business works. And I've seen people take that experience and then start their own restaurant bar because they know what they know, and they also know what they don't know. So they can find people to kind of fill in the gaps. Character is also, in the form of references. I mean, typically though, I think people are gonna, your credit score is going to be the biggest part in your experience of this attribute. Next one. Capital, again, we've talked about equity. Usually you're going to need to have, it depends on the particular circumstance. It depends on your projected cash flow, but anywhere from 20 to 30% in equity in the business to get started. The advantage of SBA loans is that there are mechanisms through which you can contribute less. But that generally means, again, you've got to qualify under that no credit elsewhere test, which startups usually do. So you can get access to lower to lower equity amounts that you have to contribute. The 504 program, the program that I used to work on, which is finances real estate and equipment, you could get as low as a 10% equity contribution, which obviously is very favorable. But it's the capital represents whatever that contribution is and whatever else you had bought previously or brought to the table to put into your business. Okay. And lenders will sort of look at that sort of on its own as an absolute number relative to the rest of, the debt that's in the enterprise, but also calculate ratios off there that give them an idea of the leverage, which is simply the amount of debt over the amount of capital in the business. Capital also refers to retaining earnings, meaning that as an owner, if I get through my first year and I'm profitable, all of a sudden I could start dividending money out to me, cash out as a return. See, I didn't take a salary. I'm gonna dividend out some money at the end of the year, which from an accounting standpoint reduces your equity. But more importantly, lenders get a little concerned about that because you're eliminating some of your skin in the game too. And so typically there are covenants that require you to keep your capital in the business until your business reaches certain thresholds of success or a certain leverage point or profitability point, at which then lenders are comfortable with you taking money off the table and returning it to yourself. Next one, capacity, ability of your cash flow to repay the debt service. And that's seen in most explicitly in terms of the forecast that's provided, modeling the projected debt service against your projected cash flow. It's also expressed in terms of profitability, but from an accounting standpoint, unless you're doing cash accounting, which is often used by small businesses for taxes, for submitting your income statements and whatnot on your tax return, which is literally the cash you've received is your revenue and the cash that you've spent are your expenses. Whereas if you have more are operating under GAAP or generally accepted accounting principles, which most larger companies do, then there are timing differences in terms of when cash actually equals profit. And as an example of that, I reach back to that 30-day terms that I mentioned before, in terms of being able to collect what you're owed. You can, under GAAP accounting, you can recognize in full the revenue when you make the sale, even though you don't have the cash from it. But that means there's a timing difference. So profitability can be actually overstate what the amount of cash flow is at that given moment. You don't actually have the cash, but you've been deemed to earn it by generally acceptable accounting standards. So it's basically, as long as a lender understands what you're presenting, whether it's on a cash basis or what's called an accrual basis, then they can understand what's going on. But essentially, they're all used to just evaluate the capacity of. And EBITDA is a acronym, the acronym that you will see frequently. It simply stands for earnings before interest, taxes, depreciation, and amortization. It's kind of the core cash flow capacity of your business before your fixed charges, like taxes, like interest, and for a lender standpoint, they'll also factor in repayment of principal in that to get an idea of what your capacity is. Next one, collateral. A lender will take a security interest in your assets, all of them. So-called personal property, which is equipment, accounts receivable, inventory, leasehold improvements, notes receivable, all kinds of, whatever it is that essentially is any asset in your business except real estate. Real estate is referred to as real property. If you had real estate, which I certainly hope you don't buy at the outset, if you have to, that's one thing, but it's nice to have. But again, cash is king when you're starting, never more king when you're starting a business. I would suggest leasing rather than buying. But if you were getting a loan against property, that would be called a real property interest. And also intangible assets, which are much more commonly in play now. And there are even lenders that will that will lend against the presumed market value of a patent. And I won't get into how that's valued, but it just shows that, with information technology and high tech, there's a lot of ideas that are, represented in patents, for example, are very valuable to a given company. They may form in and of themselves the differentiating advantage that a company has in the marketplace. So the lender will also take an interest in that as part of what's called a blanket lien on the asset of your business. And what they're trying to figure out is the lender's trying to figure out it on a real kind of quick basis. If I'm taking $100 loan, basically when I margin the assets, and what I mean by margin is discount or take a percentage of. So for example, I'm going to apply an 80% advance rate or discount rate to accounts receivable because that's a very liquid asset. That asset can actually be sold to somebody else. And it's also at the finished product stage of things. Inventory, for example, is going to get a lower advance rate. It's an essential part of the process, but it's not as marketable. So it'll get a lower percentage and equipment will get even a lower percentage associated with it. Usually maybe 25% of the net fixed asset value, net of depreciation. Anyway, apply those percentages. What's the number? If my loan is $100, they'd like to see that there's at least 110 in collateral, at least on paper. It's not necessarily backed by appraisals, sort of more intense valuations of the assets, but just on paper to see that, okay, generally I'm covered. Now you can go to the next one, Bob. Conditions, that refers to two things. Either the terms and conditions upon which you are granted a loan, and the one to note here is you will personally guarantee the loan. Starting up a business, there's no question about that. You will be personally responsible for that. You need to understand what that means. And what that means is if your business defaults on the loan, a lender can look to you personally and your personal assets to recover payments. So that has obvious implications if you own a home, and a lot of times what a lender will do when entrepreneurs are bootstrapping and they really want to get this going, they will allow a credit union, if they own a home and you've already got a mortgage, they'll allow the credit union to take a second on that. There's no dollar outflow associated, unfortunately, to you with that. There's no proceeds, but they take a second security interest so they can latch onto that in case they need to access it in some way. The second lien can either buy out the first lien, et cetera, and have access to more collateral. And it also refers to, generally speaking, the analysis of the competition and the industry vitality and viability. Next one, Bob. Recommended steps. And one thing I skipped, but I want to make sure is understood because it comes up a lot. As part of that feasibility analysis, you're answering the question, and I mentioned this, and I want to make sure that you're communicating it very clearly because people do generally articulate the answer to this question specifically in a section of their business plan, is the why. Why does your business need to exist? That's referenced in earlier presentations of this Simple Steps webinar group, but it's very important. And I've seen people just say, why does this business, why us? It's two questions. Why the business? Why does it need to exist? What's the gap in the marketplace that it's solving? What's the problem it's solving? Number two, why us? Why me? Why am I the person to go out and do this? And that's going to refer to your background, your professional background, and or any training that you've undertaken to learn more about the given business that you're going into. So just in general, kind of recommended steps, anywhere you work, okay? You can learn about how a business works no matter what you're doing. My first job was in the copy room of an advertising agency. I don't mean like advertising copy, like the stuff they do for commercials. I mean like the copier, okay? So I'm in the office supply room, but just meandering about and seeing a lot of the stuff that people wanted copies of, I came to understand that business better. and I came to understand who the people were that were involved and how the process worked. Basically, it's sort of by osmosis, you can learn about a lot about the business you're working for. No wonder, no whether what, geez Louise, irrespective of what capacity you serve that business. Build your personal credit score. I mean, it's kind of the, everybody, our credit scores are what they are. And credit scores can get hammered for a lot of different reasons. I mean, and the SBA, by the way, approves people with lower credit scores to a point, as long as those lower credit scores are explained. Because a lot of people have lower credit scores due to divorces and due to high medical bills. And where they either thought they had support in the latter case and they don't, or they can't get extended payment terms on that, it's not uncommon. So as long as you can explain the reason why on a general basis you have a lower credit score, it doesn't eliminate you from consideration. Always grow your network. Work, whether it's through work, volunteering, and events. If I've had folks that wanted to start a winery business, actually a mead business. And what they did was go around to all the fairs in the state of Ohio for mead fair, mead, where there were essentially meadery events. And get to know people, get to know the industry association. That's another way where if you're transitioning from something that's unrelated to what you want to do, you can build credibility with the third parties that you want to consider investing in your business, be they equity or debt. Again, research. Good ideas here. Cleveland Public Library, even the Columbus Public Library. If you're a resident of the state of Ohio, you can get a essentially membership in those libraries. They've got all kinds of, there are SCORE webinars. There's a SCORE webinar that's done, and I actually attended it a few weeks ago from the Cleveland Public Library, and I would imagine it has been videotaped and archived for your use. There's a lot of things they can do in terms of when you're at that business idea stage, vetting your idea, and whether it's potential customers. There's a lot of things they can do, learning about the industry. So those are a couple really good resources. I know the session 2 of this, the business idea stage, it talks about using AI, ChatGPT, for example, to use to inquire and get information back, which you should always sort of double check. But as AI is maturing with more input, you're getting more credible answers back. It's definitely a tool that you can use. So, in the same vein, grow your knowledge base if you're coming from another space. Training, say IT, for example, that's specifically relevant in terms of certifications and training. And then develop your business plan and seek funding. But thank you for your time, and hope you've got something from this. Again, as Bob referenced up front, we can help you in various ways, whether at whatever stage you are of assessing your business. There's how you can contact SCORE. If you have any specific questions about this presentation, you can reach out to me. I've also included toward the back here, I think I've got links to different, funding sources, learning more about funding sources, other websites that allow you to, there's one about grants. We had that mentioned by a participant at the outset. Next page, Bob. Crowdfunding. You can find out about Ohio funding programs. Go on the SBA, learn at your ECDI, all these different websites that can provide you information about funding. And that's really all I have. And again, thanks for stopping in tonight, and best of luck to all of you.
All right. So I'm going to stop sharing, and we will take some questions if you have any. Also, just wanted to let you know you will receive a copy of this slide deck, and the links that Dan just talked about will be live, so you'll be able to go right directly to them from the slide deck. You should also receive a recording of this workshop as well, so you can go back and take a look and listen to it again. But if you have any questions, we'll take them. I'm not seeing anything yet, either in the chat or in the Q&A. So Don't know. I'll give you a few minutes or a few seconds, I should say, and then we'll cut out. But Dan, great job. You know, every time I listen to you on this, I learned something. And Bob Fedor was quiet, so that means you covered everything.
You did a great job.
Yeah, perfect. It really was. So I don't see any questions. So I'm going to call it a night. Thanks everybody for joining us. Look forward to having you on many of our webinars coming up in the future. Go on to the SCORE website, check them out. And if you need help putting together your loan documents, if you need help putting together your business plan or your financial plan, SCORE mentors are available to help you with that. So at that, I'll say goodnight and look forward to seeing you again. Take care.